Hey traders, Ron here, Traders Academy. And as you know, it's our goal to coach and train traders of all levels. Typically we do that through our podcasts, our blogs, our meetups, and our webinars. But a few weeks ago we had the idea to put out through social media a question to all of you asking, what is your biggest challenge or obstacle that's preventing you from creating consistent trading results? And the response was overwhelming. So what we decided to do was take those responses and create a series of mini courses, each one answering a specific response. So we hope you enjoy these, hope you find them informative, and thanks for watching. Welcome everyone to our mini course number 5. This will be part 1 of a 4-part series, and this is entitled Futures. How to trade futures in large and small accounts. And our question was, I really feel more comfortable trading commodities and stocks, but I've always been told that they are very high risk. I only have a small account, so I've never really gotten involved. How should I begin if I want to trade futures, and is there a way I can trade without having the excessive risk associated with futures? Any help would be great. So first I want to say that futures market is by far my favorite market to trade. But at the same time, I'm a firm believer that to be fully and properly diversified, you need to maintain positions in all 3 markets, being equities, forex, and futures. And by doing this, you'll be much better placed to offset the wild market swings in the equities market that we so often have nowadays, especially with tweets coming from a certain you-know-who. So don't give up on the other 2, as you will need them just as well. But now to be more specific and answer your question, yes, futures are high-risk investment instruments. And first, let's discuss why they are perceived as high risk. One thing for sure is that there is a fear of commodities out there. Many investors are scared of venturing into the world of commodities, and it seems that every time the word commodity is spoken, someone pops up with a horror story about losing their entire life savings trading soybeans or cocoa or some other exotic commodity. And even though this is negative perception, is rapidly changing commodities are still often misunderstood as an investment. But in fact, commodities are an attractive investment, and they give you leverage and risk management opportunities that your average financial instrument like bonds or stocks or mutual funds don't offer. And global events can be our friend and are responsible for the run-up in commodity prices. Investors who are able to identify these trends stand to do very well, believe me. So first off, let's talk about leverage. The futures markets are characterized by the ability to use very high leverage relative to stock markets. And leverage is the use of borrowed capital, called a margin loan in a brokerage house, to invest more funds than you have liquid to increase the potential return of an investment. So leverage is basically the ability to control large amounts of capital using very little of your own capital. So again, in other words, with a relatively small amount of cash, you can enter into a futures contract that is worth much more than you initially have to pay or deposit it into your account. The higher the leverage, the higher the level of risk. Don't forget that part. So let's talk about some leverage pros and cons. So a pro would be, it allows you to make large gains with a small investment. And the con is extremely negative if the trade moves against you because your losses also are amplified by the leverage. So it's a double-edged sword. Price changes are highly leveraged, meaning a small change in the future price can translate into a huge gain or loss. And there is real possibility that you can lose more than you invested, although when I trade futures, I trade them directly and I use protective stops preventing any account from going negative. If you don't use stops, I guarantee you it is possible to lose more than you have in your account. So now let's describe an example to illustrate leverage. Because of leverage, if the price of the futures contract moves up even slightly, the profit gain will be large in comparison to the initial margin. However, if the price just inches downwards, that same high leverage will yield huge losses in comparison to the initial margin deposit. For example, say that in anticipation of a rise in stock prices across the board, you buy a futures contract with a margin deposit of $10,000 for an index currently trading at $1,300. So the value of the contract is worth $250 times the index. In other words, $250 times $1,300, which equals $325,000, meaning that for every point gain or loss, $250 will be gained or lost. If after a couple of months the index has gained, let's say, 5%, this would mean that the index gained 65 points to stand at 1365. So in terms of money, this would mean that you, as an investor, earned a profit of 16,250, which would be 65 points times 250, or in other words, a profit of 162%. But on the other hand, if the index declined 5%, it would result in a monetary loss of 16,250, a huge amount compared to the initial margin deposited that you put in there, which was $10,000. This means that you still have to pay $6,250 out of your pocket to cover your losses because you've already used up that other $10,000. In fact, that a small change of 5% to the index could result in such a large profit or loss to the investor, sometimes even more than the initial investments made, is a risky arithmetic of leverage. So like you indicated in your question, and I also said in the beginning, the major problem with trading futures is the leverage involved. But there is also several positive reasons to trade futures, and let's look at the top 6. Number 1 would be diversification. So there's abundance of commodities to trade. There's energies, metals, currencies, interest rates, equities, and even more than that. And there's usually one that is performing well that you can strategically capitalize on. Number 2 would be common sense trading, which is my favorite. Taking advantage of current events. So if the gas prices are rising, you could trade oil futures because you know what's going on. If the East Coast has an extremely cold winter, you can trade heating oil futures. You can profit from what's happening in the news. So longer term trading hours, that's another advantage. Commodities trade 24 hours a day, 5 days a week. The futures market is open from Sunday night until Friday afternoon. And this allows you to enter, exit, or have orders working to protect your position almost 24 hours a day, even while you sleep. Number 4 would be high liquidity. High trading volume helps keep the spread or the bid to ask tight, thus making it easy for traders to enter and exit the markets with their day trading. And also, speaking of day trading, there's no pattern day trading rules. So pattern day trading, PDT, rule requires that a trader have a high minimum of funds in their trading account if they make more than 4 trades in a day. But the good news is futures don't have these rules. So trade to your heart's content, but of course, trade safely. There's a tax advantage too. There's favorable U.S. tax consequences for short-term traders since futures profits are taxed at a 60-40, which means that 60% of the gains is taxed at a maximum rate of 15%, similar to long-term gains, and the other 40% is taxed at a maximum rate of 35% as ordinary income. So since we just covered 6 reasons that you might want to trade futures, I feel that I should also at least mention a few cautions that you need to be aware of, and they are, number 1, it is directional trading. So it does require for the market to move in your direction. Number 2, and a big one, is emotional management. Master your mindset for this ride because of the fact that you're so highly leveraged, and because of the fact that a small move one direction or the other can make a huge gain or loss in your account. It's easy for that kind of scenario to play havoc with your emotions. And number 3 is higher risk management responsibilities. You have to adjust your stop loss orders daily, and even more than that, you have to have your stop loss orders. Now, to properly answer this question, I'm once again going to break it down to several parts, and this will conclude part 1. In part 2, I will actually go into our trading platform and look at some of the specifics of actually trading futures contracts directly. Then, from there, we will progress in other ways to trade futures without having to take the inherent risk involved. And this will enable those of you with smaller accounts to get involved as well. But just in case all of this still seems too large of a task for you to take on, I would like to suggest another option. Instead of taking all this on by yourself, maybe you should consider coaching. Coaching is something that is used by every successful professional, and at the same time, something that is almost never thought about for the average person. But think about it for a second. Pro golfers have coaches, pro boxers have coaches, sports teams have coaches, pro skiers have coaches, actors have coaches, even rock bands have coaches, and the list could go on and on. And one thing you may not know is that traders have coaches too. In fact, I can promise you that all successful professional traders have coaches. In fact, all brokerage firms employ in-house coaches to support their in-house traders. And when I worked on Wall Street, I used their in-house coach all the time. So whatever path you decide to take, I just want to encourage you not to give up on your dream to become a trader. There is not another business in any field that has the potential to produce the kinds of gains possible as a trader. Remember, it's all about following the process, breaking it down into workable sections that you can tackle with ease. And remember, if you don't feel like going it alone, consider coaching. We want to thank you for watching. We hope you enjoyed it and hope that the information that you got can in some way help improve your trading. And if you'd like to watch the entire series for free, all you have to do is go to tradersacademy.org. That's tradersacademy.org. Fill out the form, give us your email address, and we'll send you a link to the entire series. Plus, we'll give you a free copy of our Reprogramming the Trader's Mindset book, and we'll give you access to a free 1/2 hour private coaching session. So if you'd like to take advantage of this offer, again, that's tradersacademy.org, tradersacademy.org, and thank you for watching.